Primary capital markets move at a pace that is often unforgiving. To function, institutional capital requires immediate structural clarity before a single dollar is committed. In Indian markets, that clarity is provided by the Draft Red Herring Prospectus, or DRHP. It serves as the legally binding architectural blueprint for any company seeking to go public. While a retail investor might see an impenetrable wall of boilerplate text, an institutional analyst reads the exact same document as a precise map of risk and regulatory constraints. This document is the DRHP for MV Electrosystems Limited. The header immediately establishes the structural nature of this specific offering. Pulling back to view the full page reveals how critical financial data is buried directly within dense blocks of legal and standard formatting. MV Electrosystems is attempting to raise 2.9 billion rupees in public markets, but they are doing so under a highly restrictive regulatory framework. This taxonomy defines the specific risk profile regulators have forced upon this IPO. To understand the mechanics of this raise, we have to start with a fundamental question. Where exactly is the capital going? We find the answer in the issue details table. The company is issuing fresh shares to bring 2.9 billion rupees directly onto their balance sheet. Next to it is a notable absence. The offer for sale column simply reads, "Not applicable." Many IPOs act as an offer for sale, allowing early investors to cash out. This transaction is a 100% fresh issue. This means zero public capital is being used to provide exit liquidity to the listed promoters, like Mohit Vora or Amit Dhawan. Instead, the fresh capital is designated for operational restructuring, funding the shift from their current Delhi facility to a new site in Haraya. Producing electrical equipment for railway rolling stock requires massive physical infrastructure. Moving these heavy operations requires a specific scale of balance sheet funding. Because there is no offer for sale, 100% of the public capital is absorbing operational execution risk rather than enriching the founders. If all capital is funding pure operations, why has the regulator flagged this issue with structural restrictions? We return to the document to locate the exact legal clause. The text specifies the issue is being made pursuant to Regulation 6.2. This is followed by a legal admission. The company did not fulfill the requirements under Regulation 6.1. The baseline rule, SEBI Regulation 6.1, requires issuers to possess a proven historical track record of profitability and net worth to access public markets normally. Failing that threshold carries a specific consequence. The issuer is instantly classified as possessing a higher inherent risk profile. As the regulatory body enforcing this risk taxonomy, SEBI steps in. SEBI does not block the IPO for failing 6.1. Instead, it replaces standard participation rules with a restrictive set of mandates. Regulation 6.2 acts as a mandatory quarantine protocol, altering the capital structure to protect retail money from unproven corporate ventures. That quarantine dictates the mathematical reality of capital allocation. A normal IPO allows for a balanced distribution among investor classes. Under Regulation 6.2, that balance is wiped clear. MV Electrosystems is subjected to a massive institutional requirement, locking 75% of the total issue strictly for qualified institutional buyers. These are sophisticated entities, like mutual funds and commercial banks, that possess resources for independent due diligence. Conversely, the allocation for everyday retail individual investors is squeezed down to a maximum of 10%. Capping retail exposure is SEBI's direct method of shielding the general public. The final allocation block leaves 15% for non-institutional investors. This block is internally tiered based on bid size, separating applications between 200,000 and 1 million rupees from those exceeding 1 million. This pie chart represents forced institutional price discovery. The IPO cannot succeed unless heavy institutional capital validates the valuation. This creates a mechanical challenge. How does an issuer secure that massive 75% institutional mandate? We find the execution mechanics in the timeline data on the second page of the DRHP. A critical event occurs before the public is allowed to participate. The timeline designates an anchor investor bidding date, set 1 working day prior to the issue opening. The lead manager can allocate up to 60% of the total QIB portion to these anchor investors on a discretionary basis. Securing these anchor investors early establishes a baseline price conviction, signaling institutional confidence before main bidding begins. When the retail and non-institutional bidding opens, transactions are handled through ASBA, applications supported by blocked amount. The core protection of ASBA is that an investor's funds are never transferred to the company during bidding. The money is merely blocked in the investor's bank account until final allotment is confirmed. To see how the company frames this high-wire act, we return to the cover page. The document features a legal warning stating that there is no formal market for the shares and no assurance regarding the trading price after listing. The DRHRP is a balanced regulatory equation. The company must openly disclose its foundational risks in the text, while the regulator